Hello everyone. We have come up with an exciting announcement regarding the static banking awareness. Before going to the announcement, I want to tell what our static banking awareness course is all about for people who are not aware of it. So if you see, the static banking is the core and the current affairs that we cover on a regular basis is the layer upon the core. So you have to know about the static concepts in order to have a wholesome learning of the current news are covered and explained to you. Say suppose there is a news about PSL. Say suppose the Reserve Bank of India has increased the target of PSL for one particular sector from this percentage to this percentage. Okay. So this we would have covered in our current affairs. So you will know the old percentage as well as the new percentage. What if you want to know what is PSL? Who initiated it? Why it was initiated? And is it applicable to all types of bank? And what if the bank failed to meet the target? What will happen? For all this, if you see, we have covered in our static banking awareness course. So here it is updated up to 2025, and this course, if you see, it is applicable and relevant to all banking exams starting from RRB, IBPS, SBI and also the regulatory bodies. Now okay, coming up to the exciting announcement. So here in the upcoming days, if you see, we are going to upload the videos of the static concepts one by one in our YouTube channel for free to our subscribers. So you can go watch the video of the static concepts, and if you're interested, you can log into our applications, go to all courses, and there you can purchase our static banking awareness course. So here if you see, while purchasing, you can also use a discount code, that is RS10, to avail an additional 10% discount during the purchase of the course. Thank you. Today we will be covering the origin and development of banking in India. So how banking process started in India and how it developed from which stage to which stage, all this will be covered in this topic. Before knowing the banking concept, we need to know the circular flow of income. Now consider there are three entities in the system. One is the government, next is the private player, and the third is the household. So the government, if you see, the ultimate aim or the ambition of the government is to improve the economic of the country. To improve the economic welfare or economic development of the nation or the state is the first priority of any government. So for that, if you see what is required, economic activity has to take place. That is nothing but the production of goods and services. Only then the economic activity or the economic development will take place in any country. And for that purpose, huge amount of capital is required, right? So huge amount of capital required for both acquiring of land, for construction of the building, for acquiring of big machineries. For everything, huge capital is required. So for this, capital is required. Next is the private player. Here the private player main ambition is to make profit. That is the ambition or that is the focus of any private player. So here if you see, they are the integral part of the prices of the goods and services. So they play a very vital role in deciding the prices of the goods and services, which is mostly dependent upon the demand and supply in the market system. So to meet the demand, one should produce more goods and services. So if the demand is high in the market, then eventually more goods and services should be created, right? So for creating more goods and services, again what is required? Capital is required. So again here also the private player requires capital. Now coming to the third entity. Third entity here is the household. So individual household. So the individual household, if you see, it will be employed by these private firms as the employees. They will participate in the production of goods and services. They will be as workers in the production of the goods and services. And this activity, that is after production, this will generate income for both the private player and as well as for the individual households. Now this again, it can be sent. The income of the private player will get income from the sale of goods and services, and from that it will provide wages to the individual households, and these individual households will then be used in maybe purchasing various goods and also for saving. So if you see, this is the circular flow of income. So on one hand, if you see, it is the government and the private player who require capital, huge amount of capital or money for the development purpose. On the other hand, if you see the individual household who are ready to provide labor support for the production activity. So here, if you see, the demand and supply comes into place, and when the demand and supply gap is full, the economy will start to run. So the capital formation is a very important part. Now, how to get this capital? To whom should we ask the capital? That is when the financial system comes into place. So the financial system, if you see, it majorly consists of the financial institutions and financial regulators, financial instruments, financial market, and the financial services. Financial institutions like banks, NBFC, these all are financial institutions. Financial regulators are the one who regulates these financial institutions. So if you see RBI, SEBI, NABARD, they are all regulators. Next is financial instruments. So these are the instruments that are traded in the market, like certificate of deposit, treasury bills, the shares, the bonds. So all these are financial instruments. Financial market is where these financial instruments are traded. That is like primary market or in the secondary market. When it is issued for the first time, it is done in the primary market. When it is already existing in the market and second trading happens, that is between the various buyers, then it happens in the secondary market. This is what financial market. Next is financial services. Like they will give you mutual fund advisory services are all right? Mutual fund, it is a financial service. And also investment advisory services is also provided, right, by the investment bankers. That is a financial service. So these all together constitute this financial system. It is not just the financial institution. Financial institutions, regulators, instruments, financial markets, and the financial services together constitute this financial system. Now we'll concentrate on the banking institution. This banking institution majorly consists of two types. One is the normal banking institution. The next is the development financial institution. Now we look into the normal banking institution. So say there is a bank. Okay. So how will they operate? There is a depositor. He comes and deposits money in the bank. Okay. So that he could earn interest from the deposits, and also his money is safe. Main purpose of deposit money is interest, and also the money will be safe in the bank. That is the main purpose of depositing money by the depositors. Next, another person. Another person is there, A, and she has come to the bank to request for loan. Okay, so if you see, now bank, what will do is, now a depositor A had come, and let this be B, and a loan borrower B. So depositor A had deposited some money, and B wants to borrow some money. This money from the bank, it will go to the borrower. This is how the bank works. It acts like a bridge between the depositors and the borrowers. So it will collect the interest it will give the interest to the depositors, and it will collect the interest to the borrower. So this is how the bank works, and this is the traditional working of a bank. Okay. Now let us go to the development financial institution. The developmental financial institution, from the name itself, you can guess that what is the purpose of it. So for developmental activities, it is very easy to guess from the name itself. Main aim was to improve the entire development of the country. So previous thing we saw that in case of normal banking institutions, one of the main aim is to get profit, and also here the target customers in non-banking institutions are resident people like normal individuals or the business people. Okay, but here development financial institution is to provide loans, that is huge crores and crores amount of loans for the development infrastructure, for the setting up of factories, for the improvement of highways, so which requires a huge lock-in period. Here if you see, the development will take 10 to 20 or even 30 years. Development, if you see, it is a huge lock-in period, and so since a huge amount of money is provided to the borrower, it is very difficult to get a high interest, right? It will not be very easy for the borrower to pay high interest. So they will be given at an economic interest rate. The developmental financial institutions, they will provide loans to the borrowers at a reduced or an economic interest rate, because the purpose of the loan is to improve the infrastructure, that is for the entire development of the country. That is why. So if you see, main purpose of this development financial institution is to promote the economic development, social welfare of the country, to provide long-term financing, like hundreds and thousands of crores will be provided for the improvement of the infrastructure and also the factories and also for the economic development. For that purpose, reduced interest rates will be provided. The example of this development financial institution is like Exim Bank and also NAPFID. These and all, if you see, they will provide huge set of loans at a reduced interest rate. These are development financial institutions. In previous slide, we saw like normal banking institutions, right? Those are nothing but like SBI, HDFC, Punjab National Bank, ICICI Bank. These are all normal banking institutions. This is the main difference between developmental and financial institution and normal banking institution. So majorly, who owns the banks in India? If you see, there are majorly two types, two categories under this. One is the public sector banks, the other is the private sector banks. From the name itself, you can find out that the public sector bank, the major shareholder is the government, and the private sector bank, the major shareholder is the private player. So if you see, public sector banks, more than 51% of the shares are held by the government of India, and private sector, more than 51% it is held by the private sector players. So these are the major shareholders of these public sector and the private sector banks. Next is the history of banks in India. To learn about the history of banking system in India, it can be, that is, the banking system can be majorly divided into three time gaps. First one is before 1947, that is before the independence era. How was the banking system then? Next is between 1947 and 1991. And next is after 91, when the economic or the financial crisis or the reforms had been done in India. So why it has been divided into three major? Because from in each period, different or major changes have been brought into. That is why learning of banking system is divided into three major time gap, that is before 1947, between 1947 to 1991, and after 1991. So let us see before 1947 period. So if you see before 1947, Bank of Hindustan was the first bank of India. The first bank established in India, and it was established in 1770, but unfortunately it was liquidated in 1832 due to crisis. Later on, after Bank of Hindustan, General Bank of India was initiated or was formed in 1786. And the next bank is the Bank of Calcutta, which was established in the year 1806. And Bank of Calcutta, if you see, it was renamed to Bank of Bengal in the year 1809. So these are the banks, if you see, majorly. Next, if you see, the main purpose of the banks established then was to provide trade services to the British. That was the main reason for creating banks. And if you see President's banks, there are totally three President's banks that existed in India. One is the Bank of Bengal, next is the Bank of Bombay, and third is the Bank of Madras. So these were the three presidency banks that existed in India, that is Bank of Bengal, Bank of Bombay, and Bank of Madras. And these presidency banks were merged together, and then it formed the Imperial Bank of India in the year 1921. In 1921, this Imperial Bank of India was formed by merging three presidency banks, that is Bank of Bengal, Bombay, and Madras. So in 1840, if you see, Oriental Bank Corporation was established mainly to service the Indian traders, to provide loans to the Indian traders. Next, in 1865, Allahabad Bank was introduced. So if you see, this was the oldest public sector bank. And now you know that Allahabad Bank has been merged with the Indian Bank. So Allahabad Bank does not exist anymore. It has been merged with the Indian Bank. So let us cover the era from 1947 to 1991. This was after the independence. So if you see, after the independence, nationalization of bank took place. What does nationalization of bank? Major banks were private sector. They were privately owned. So it was realized that government should have a majority share in this private sector banks, that is privately owned banks. So majority of the shareholding passes to the hands of the government. Now why was this decision taken? It was because to provide banking services to accessible to more masses and to promote economic growth and reduce the inequality. If you see, since the banks were privately owned, they were giving loans majorly to the industrialist, to the high net individual, to their own relatives. So They were trying because their aim was profit maximization. And due to this, only people who were easily already accessible to loans, only they were getting loans, and people who were in need of loans like the farmers or for the education purpose, all these people were deprived of loans. That is why this decision of nationalization was taken. So if you see, first in 1955, State Bank of India was nationalized. Next, around 14 private sector banks were nationalized in the year 1969. Next, 6 private sector banks were nationalized in the year 1980. Remember, the timeline is very important. 1955 banks were nationalized in, State Bank of India was nationalized in 1955. In 1969, private sector banks, around 14 banks were nationalized, and in 1980, 6 banks were nationalized. Now, what was the positive and the negative side of this nationalization? So, every decision that has been taken, it always has a positive and a negative side. Now, let us cover the positive side. The first one, if you see, this helped the growth of the economy. It helped in the entire growth of the economy, and mainly the loan was given to the priority sector, that is to agriculture, small scale industries, to the exports. No, small, not major scale. On small scale, people do exports, right? For those people and all, the loans were provided under the priority sector. And also, if you see, this promoted growth in all the sectors. So previously, when it was privately owned, only few sectors were seen growing because loan were permitted only in few sectors. Loan were given to only few sectors. Now, after the nationalization, all sectors were seen, all sectors witnessed growth. So that was, these were the positives of the nationalization. Similarly, what are the negative side of the nationalization? First is the lack of autonomy. What is this lack of autonomy? So if you see, these were, since the banks after nationalization, they were primarily owned and controlled by the government. So major decision making process was not done by the bankers, but it involved the government people a lot. A lot of interference happened from the government side. That is why lack of autonomy was observed as a negative thing. And also, if you see, lack of competition. Only when they were privately owned, they had to compete with each other. But now, if you see, the major shareholders were the bank, were the government itself. That is why a lack of competition was observed. Next is increase in NPA. NPA, we know that they are non-performing assets. So these are the assets whose principal and interest were not repaid for like 90 days. When you do not pay the interest or principal for straight 90 days, then that loan becomes an NPA. And after this nationalization, the NPAs in the banks started piling up. So government-owned banks, if you see, they were often directed to certain sectors, and that sectors failed to repay. And that led to the increase in NPA, which increased the burden on the government because they were the major shareholder of the banks. Next is drain. Government's resources started to drain. So how this? You know that huge capital is required for any business. Even for banking business, huge capital is required. Now, who puts this capital? The owners. In this case, if you see, the major shareholder is the government. So when banks need capital, the government has to provide the capital from their side. So this led to the drain on the government's resources because they had to invest significant amount of public funds in the bank, and this, if you see, which could have been used for other developmental projects, that fund has been used in this. That is why a huge drain of government resources was observed, and these all comes under the negative side of the nationalization of the banks. Next is after 1991. So 1991, we know that the economic reforms happened. So India, we know that the forests and the foreign reserves almost drained. So we did not even have enough money to import for the next 2 weeks, 2 or 3 weeks. That time we had to go and borrow money from the IMF, International Monetary Fund. So when we had to borrow money from the International Monetary Fund, there were certain conditions stated by the IMF that had to be fulfilled in order to provide money to the country. So these were mainly, if you see, LPG reforms were introduced. LPG is liberalization, privatization, globalization. So these LPG reforms were introduced in India. So LPG, we know that L stands for liberalization, P privatization, and G globalization. Globalization is when the Indian economy was open to the world. So the heavy restrictions on the import and export was reduced, and privatization, if you see, this especially increased competition among the banks. Many private sector banks were welcomed. So many private sector banks started to open the base in India, and also the maximum investment, if you see, there was a limit, foreign direct investment in the banks. So that cap was increased to 74%. FDI, foreign direct investment, it was increased to 74% so that foreign investors can come and invest the money in our banking system. And also private sector players then come and open the banks in the open their banks in the India. So this increased competition, this increased efficiency of both private sector banks and public sector banks as they were competing with each other. So this increased the overall health of the banking system. LPG reforms increased the overall health of the banking system. This was the impact on the banking system in India. Foreign direct investment. In short, FDI, if you see, it is permitted both in public sector banks and in private sector banks. But the limit varies. In public sector banks, if you see, the limit is 20%. Up to 20% of FDI investment is allowed in public sector banks. Whereas in private sector banks, 74% is allowed. And under 74% also, there is two categories. Okay, one under the automatic route and another under the government route. So under the automatic route of the foreign direct investment, up to 49% is allowed, and above 49%, up to 74%, it is allowed under the government route. Okay. See, the difference between the automatic route and the government route is that under the automatic route, you do not require prior approval from the Reserve Bank of India or from the Government of India. Okay. Prior approval is not required. Whereas under the government route, a prior approval is required from the Reserve Bank of India. Okay. That is the only difference between the automatic route and the government route. And you should remember, the limit is 20% in case of public sector banks, and in case of private sector banks is maximum of 74% of FDI is allowed.